The world's first mutual fund appeared in Amsterdam, 1774, as Dutch merchant and broker Abraham van Ketwich invited subscriptions from investors to form a trust, named after the maxim of the Dutch Republic. Unity creates strength. The goal was to provide small investors with limited means and opportunity to diversify. This first mutual fund spread risk by investing in several geographies in Europe, such as Austria, Denmark, and Germany, and plantations in Central and South America. Today, more than 250 years later, mutual funds remain relevant to individual investors around the world. Should you invest today in active mutual funds? The evidence is both shocking and sobering, as we'll see. We'll start our account of the world's first mutual fund with its context: the Dutch Republic, then the world's wealthiest country and the center of global finance. As we saw earlier, Amsterdam is the world's first stock exchange, since 1602. Scholar Gerrit Rouwenhorst shows that, in the 1770s, Amsterdam was the world's deepest capital market, with over 100 securities traded. The bulk of trading was in government bonds by Holland, France, and England. Corporate stock traded more thinly, such as the Dutch East India Company, or the Bank of England. A third major category of securities was plantation loans, collateralized by mortgages in the Dutch West Indies. Rouwenhorst continues. The two main innovations that then took place in Amsterdam were securitization and stock substitution. Securitization uses the cash flows of illiquid claims as collateral for securities that can be traded in financial markets. In a stock substitution, securities are repackaged individually or as part of a portfolio to make them easier to trade, either in smaller denominations or at a lower cost than the underlying claims. Often, these innovations were designed to overcome barriers associated with investing abroad, such as foreign registration requirements or the costs of collecting dividends, which excluded smaller investors. With these two financial innovations in place, the world's first mutual fund was ready for launch. In July 1774, the Amsterdam broker Abraham van Ketwich invited subscriptions from investors to form a trust. This trust was named after the maxim of the then Dutch Republic: unity creates strength. In Dutch,
Eendragt Maak Magt.
This novel security was to invest in foreign government bonds, bank bonds, and plantation loans in the West Indies. Investors were promised a 4% dividend. Subscription was open to the public for 2,000 shares. Later, participation in the fund was also possible by purchasing shares from existing shareholders in the open market. Investors had a choice to receive shares registered in their name, or in bearer form. Scholar W. H. Burgess considers this the world's first mutual fund. The sales prospectus of Eendragt Maak Magt specified categories of potential investments, shown here. For the first time in history, individual investors had the opportunity to diversify risk across geographies, industries, and securities types. Rouwenhorst continues. Fiduciary responsibility was promised. The prospectus required Van Ketwich to provide annual accounting and full disclosure to all parties. For this, Van Ketwich received a commission of 0.5% upon launch, plus an annual compensation of 100 guilders per investment class. The physical securities invested in were stored at the office of Van Ketwich, in an iron chest with 3 different locks. In addition to specifying investments, the prospectus required that the portfolio be diversified at all times. The 2,000 shares of Eendragt Maak Magt were subdivided into 20 classes. Each class was to consist of at least 20 to 25 different securities. The fund was diversified, yet the fund's main investments were plantation loans in the West Indies. Eendragt Maak Magt was likely aimed at smaller investors who would be unable to achieve this level of diversification on their own account. The bonds in its portfolio had a face value of 1,000 guilders, and replication of the portfolio by purchasing these securities in the open Amsterdam market was only feasible for investors of considerable wealth. The world's first mutual fund thus created an opportunity to obtain portfolio diversification in portions of 500 guilders. The initial success of Eendragt Maak Magt soon invited followers in Holland. In 1776, a consortium of Utrecht bankers founded a second mutual fund, named Profitable and Prudent. This time, Abraham van Ketwich did not act as an administrator, but the prospectus lists his office as a collection agency for periodic dividend payments. Remember that its main investments were plantation loans in the West Indies. But the 1780 English War hampered shipments, and proceeds pledged as security for plantation loans. In 1782, the decline in investment income forced Van Ketwich to suspend redemption of shares and lower dividend payments. In the 1790s, the mutual fund disappeared from the Amsterdam Stock Exchange. In 1811, the share price of Eendragt Maak Magt traded at 25% of face value. In sum, individual investors got screwed. A summary of the outcome: individuals who bought Eendragt Maak Magt in 1774 were down a staggering 75% by 1811. And the seller, Abraham van Ketwich, was paid 0.5% of all raised capital to launch the fund, and was paid 2,000 guilders per year, every year, over more than 30 years. The logic of mutual funds has not changed since. The seller will always win. You, the buyer, will most certainly lose, as we'll see. The first investment trust outside of the Netherlands is the Foreign and Colonial Government Trust, founded in London, 1868. Like Eendragt Maak Magt, it invested in foreign government bonds. By then, investment trusts had existed in Holland for almost a century. In present day, given the pervasiveness of mutual funds around the world, an important question for you is: should you invest in mutual funds? If yes, which type? After World War II, mutual funds took the US by storm. They were widely bought and sold. But how did they perform? In 1962, the SSE commissioned a study to Wharton. The conclusion: mutual funds performed worse than a random portfolio of securities. Individual investors would better off throwing darts rather than investing in the average active mutual fund, said famed Paul Samuelson in a US Congress hearing. More evidence on the underperformance of active mutual funds was produced by Bill Sharp in 1966 and Michael Jensen in 1969. Mutual funds charged a lot and delivered bad performance. Individual investors would be much better off buying the entire market rather than active mutual funds. But the first index or passive fund for individuals would not appear until 1976. Do active mutual funds still underperform today? Yes. Scholar Cuthbertson and friends show how. The popular press concur. In 2022, the New York Times showed that not a single active mutual fund out of over 2,000 beat the market in the previous 5 years. Today, just like 20 or 50 years ago, individual investors should avoid active mutual funds like the plague. Our verified sources are shown here. We encourage you to tell us if your interpretation is different, or if you'd like to suggest other verified sources. What do these tell us altogether? There is no doubt that the first mutual fund appeared in Amsterdam, 1774. There is also no doubt that active mutual funds underperform on average. Scholars offer many reasons why some individuals still buy active funds. Today's takeaway is simple. We thank the Dutch for inventing the world's first mutual fund. We also recognize that active mutual funds are not today's best solution for individual investors. We'll see soon how the world's first index fund was launched in 1976. Thank you for watching. If you'd like to see more financial history from verified sources, subscribe to our channel and join our community of individual investors who strive to learn from the misfortunes of others to avoid similar fates.